Afternoon. Good afternoon. Thank you very much for inviting me. Everybody at SESFRIC, I wish to congratulate you, and this has been a remarkably well-organized, well-presented symposium conference, and the staff is really at every level to be commended. I think Ahmed and I only learned this today, probably have the same grandmother, because when I started doing Islamic finance, everybody was sure that I was a spy. I'm going to talk to you about some different aspects post-angel stage, except for the very important comment about the equity gap. But so everything from the angel stage or the equity gap stage up through microcaps, which I will define for today as 5 million euros or less. So some of these companies become successful. They're still in great need of financing. They still have great needs in this regard. These are the questions, and some of the slides, these are available, so some of them I'm going to skip or go through only one point or something, and you can take it up later. I would like to focus toward the end on private equity involvement, and by that I mean venture capital and beyond. Different types of venture capital, but starting with different types of private equity, starting with venture capital. So I'd like to kind of frame this by looking at the 2007 financial crisis. What happened? What do we take from that? Are there opportunities out of that? And come back to the private equity discussion. Clearly, there were big problems. Exacerbation of all kinds of problems for SMEs, and the SMEs took it the hardest in that period. Large entities still access the capital markets, and by that I mean even mid-caps and up could access the capital markets to some extent, and they could access non-bank financial funding of various sorts. And those present opportunities. There are ways to develop some devices, both equity and sukuk type devices, to allow microcaps and below to access. But they have to be pooled vehicles usually. There aren't too many of them. It's an idea worth exploring. What happened to SMEs? Well, this is pretty obvious stuff. Reduced cash flows, lots of bankruptcies, unemployment, inability to get financing. They were hit disproportionately. These SMEs, and by that I again mean microcaps and above, so very small entities as well. These are the devices they usually use for financing, roughly in order going down. The frequency is greater toward the top. They rely on overdraft protections of different types and lines of credit. Obviously, a very unstable sort of financing program. But let's look at that. What happened? There was a great increase by SMEs in their need for capital. They lost a lot of the bottom half of that previous chart. What was available to them were overdrafts and lines of credit. And these largely came from banks, because that's all banks would give them. And they increased very dramatically if you looked at some of the numbers. Well, that's a very unstable financing regime. A lot of stress on the institution. Higher interest rates, shortened maturities, all of these factors, increased collateral demands. All of this is bank-related again. It's loans. And we'll come back to this. But they also suffered on the demand side. They couldn't sell their products. The demand for their products went down. There were some government programs, particularly oil and gas, as was pointed out, that tried to maintain that. There weren't a lot of those that tried to maintain the demand side versus the supply side. Anyway, overdraft and credit line usage, horrendous increase. I put up only 2 countries here, but if you look at this country by country, there's data available on maybe 30 or 40 countries, pretty good data. This is only to show that the variation in how SMEs finance is really great. So the Eurozone, they rely on banks. The U.S., only 24% of the SMEs have bank financings. So when we're thinking about devising some strategies, it's got to be very local, market by market sort of undertaking. I'll suggest that we should change the structure a little bit and not rely so much on debt, but debt will always be, in one form or another, whether it's Sharia compliant or otherwise, will always be an element. Government responses. What were the government responses? There was some attempt to support the demand side. There was some attempt to avoid depletion of working capital, enhance access. It wasn't terribly successful. One of the problems is the public debt of governments has been increasing rather dramatically, as people have indicated, which puts a lot of pressure on the ability of the government, absent minting money, to provide financing. And that's something we have to think of. We'll come in a second to slides. What did they actually do? And these are kind of gross figures. You can break these down by jurisdictions, but these are summaries. I suggest that in each jurisdiction you kind of look at what the government's willing to do and has done, two different categories, hopefully, and see if you can induce more equity involvement. See if you can help restructure that. Take that, what you can get from the government. Personally, I think there should be a movement into the private sector to supply some of the equity, and some thoughts, we'll have some thoughts on how you might do that. Venture capital and similar funding declined very, very sharply. Some countries tried to move their financing stage back toward the angel category. That's pretty limited, but the thought was there. Some people did try. The interesting point in some way is that SME applications for financing decreased markedly. They were defeatist about it in a sense. Oh, we're not going to get the money. And they didn't even apply for the funds. And it was a really noticeable drop. Well, that's an educational sort of thing. You know, that can be addressed with educational tools. Governments tried to be sensitive. Here's the types of things they do. Total amount available was increased. Loan guarantees were increased as a substitute for actually giving cash. They tried to expand the categories. Well, I would suggest that there are lots of opportunities to work with the governments and try and take, we'll come to it in just a second, but the Islamic finance, the Mudarba and Musharaka approach, which I think personally works very well in a lot of categories. That is what private equity is in many categories. Work with governments in trying to expand. But again, you look at these are mostly debt-related items. The government addressed debt for the most part. There was very little effort to address the equity side. Here were the new instruments, types of new instruments that were created for SMEs during the 2007 to present period. Well, again, guarantees of what? It's mostly debt. There was very little effort to inject equity capital at any point or to find people to inject. So you went to pension funds and started using pension funds. Their equity capital guarantees were not entirely absent, as you see, but it was really very limited. Mutual and cooperative associations, again, got some attention. These are SME-specific items from different countries that I kind of picked out. Again, debt-oriented, deferrals of tax, capping interest rates, rollovers, extensions of tenors, those types of devices. The focus was on debt. Again, I think there are lots of ways that we can work to inject some of the equity investing principles, the equity risk principles from these aspects of Islamic finance into this process. And we've started talking to regulators. We spent last week in Germany working on a very similar arrangement at the very micro cap level. So I'll come back to that maybe as well. Anyway, the focus is on lending, and I think there needs to be an effort to shift the focus some with governments and with SMEs. Our experience last week in Germany, for example, I'll give you one little example. and realizing these are not Muslim businessmen, they called me to ask about money from the Middle East. And the idea, I go to talk to them about, well, do you know what's going to happen to your business if you do this? You have to do everything in a Sharia-compliant manner. You can't walk down to your community bank anymore and deposit your receipts because it's an interest-bearing bank. Well, as people have pointed out, Germany, there are an enormous number of local banks, and that's how people do business. These are small companies. They do it locally. You know, there are only 11 to 60 people, employees in these companies. Well, every single person, I mean, we suggested things like, and we tried it out on 2 banks. We went and said, all right, if we put our money in your bank, as just one idea, we put our money in your bank, we don't want any interest income. But in exchange for that, would you not charge us any fees? Both banks came back a day later and said, yeah, that's workable. We can do that. So you're going to go through a host of problems like that, but many, many problems like that. What do we need? More capital into the Islamic finance system, more capital in particular into SME segment, and some global movement of capital. It can't all be local. How do you induce people from, say, the United States or England to invest in the SME segment elsewhere in the world, is the question. I think Islamic finance happens to be very well situated in these areas. Mudarba, let's just think of a mudarba as we're going through this process. It has the tools. It fits perfectly with what these private equity people do. In these early stages, they don't want to change the management. They want to let the management work. They want to fund it. Yes, they take a board seat. But all of the people I know in that lower category, they want to respect the fact that this entrepreneur built a business and has the potential to build it further. So they study the markets and they study the organization and they try and enhance that profit. They aren't there. This isn't the financial engineering segment of private equity. This is the low end where they are very respectful of the environment that they're looking at and the people they're looking at. Okay, so I think those mesh well. I think there is an absence of knowledge. My week in Germany last week very clearly indicates that. There's much more receptiveness, though, than people guess. Every one of we went to 15 microcap companies that this private equity company is thinking of buying. They're in fairly advanced stages with all of them. You know, past term sheet type stages, which in that small portion, that small end of the business, you don't execute a term sheet unless you're very, very certain you have a deal. The pricing's all done, all that sort of thing. Getting people from the U.S. or England is a little more difficult. They have return expectations that are high, and these are small companies. It takes a lot of time to analyze a small company. So we were discussing the other day that, you know, the common complaint is, out of the Middle East, I can get $150 million, but I can't get 10. It's a problem. You know, it takes time, and nobody wants to focus on the small end of the markets. Legal and regulatory disincentives are many. These are just a couple examples, but in looking at the taxation, you know, you talk about tax reform. Any company that has, I have to look back here. Any company that has global taxation, like a U.S. party, tax reform in local jurisdiction doesn't help them. You don't get any benefit out of that on your international investment, and that's very common. So what do you do with situations like that? It's all tax treaty different. You know, people aren't focusing on the facts that you have to go amend your tax treaty. And tax treaties aren't that hard to amend, except you're dealing with governments that take some time at these things. But short of amending that tax treaty, you can't give them any benefit, the U.S. private equity investor any benefit, or the English investor, whoever it is. Foreign investment restrictions are another very important area. Just two. Education of SME providers. You would be amazed. They know nothing about how they get money unless they dealt with an angel. If they dealt with an angel, then they know what the next step is. They know they're going to sell to a venture firm, some portion of their investment or maybe a lot. But the percentages that I see are very similar. That is a tiny fraction of what's going on. And look at more successful businesses, one-person businesses. There are 750,000 companies in Germany alone that are SMEs that are run by basically one person age 55 to above who probably does not have a successor. The kids don't want to do it. They're gone. Think of those markets. That's the backbone of your economy. These are very successful companies. They're $5 million EBITDA. They aren't hugely successful. But they're in rural communities. Nobody wants to go there. Important segment. Education is highly necessary in those areas. All right, tax treaties, international tax treaties, trade treaties of various sorts, local impediments. And these apply all the way back to the beginning entrepreneur stage, not just to the segment I've been talking about. Foreign investment restrictions, foreign expertise, although the entrepreneur may not get much from that. But increasingly, it is a global economy and money does move that way. Domestic tax, funds repatriation, currency, rather tedious sorts of things, but this is what prevents people from doing it in many instances. It's not that there aren't small cap investors or micro cap investors who wouldn't be interested. It just makes no sense for them to cross the border unless all these sorts of things get fixed. The last one, including bankruptcy in particular, I have a number of private equity firms as clients. This is a critical factor to them, the bankruptcy. But all of these things, as they say to me repeatedly, I don't care what the regime is, although I would hope that they would change it to encourage investment. I really don't care what it is as long as I can price it. So what's the bankruptcy risk? It's astronomical in OIC jurisdictions. There aren't any bankruptcy systems that are dependable. It's overstating the case, obviously, a little bit, but it's very risky. It's a pricing issue to them. It's not that they won't participate. The tax and foreign investment and repatriation, that will stop them from participating. And then there's knowledge of the markets, but that you can do with alliances in their view.
Michael Bey, son iki tabloyu, the last two tables, please. Thank you.
This is the last slide.
Thank you.
What do we want to do? We need some study, some fairly detailed study, and we need to target the markets and think very carefully about them. I think we should integrate Islamic finance structures. Mudarba structures in particular, Musharaka, don't work quite as well, but they aren't ruled out by any means. Mudarba is made for private equity and vice versa. Study the capital markets too. I haven't talked about them much, but there are some real opportunities there. Work with governments to modify their existing approaches. Very few of them acknowledge Islamic finance. Very, very few. And there'll have to be some changes there. Most importantly, integrate, cooperate, create. Thank you so much.
Çok teşekkürler. Thank you.